Right. So if you look at the overall inflation picture, there are a couple of drivers here, right? So one being supply chain disruptions. If you assume that things, continues to be the congestions remain and disruptions remain, but they don't get quite as bad. They're not worsening at a pace quite as rapid as last year. Then you should be getting sequentially some stabilization. And in terms of oil prices, we're already, I think, near the level where we think is reflecting a lot of the underlying supply inelasticities. Obviously, geopolitical headwind is still a wild card, but assuming that doesn't last in the second half of the year, we should be getting some more positive base effect in the second half of the year. The key thing is really the labor market in the U.S. And I think that as we see the Fed starting to front load more of their policy tightening, and as we should start to see labor market wage expectation becoming more anchored. And that also means that into the second half of the year, we should see that inflation pressure starting to change.
In which case, Julia, do you think that Fed pricing as it is now is too aggressive?
Well, I think that the Fed is trying to catch up from a position of being somewhat behind the curve vis-a-vis inflation data. I mean, I think they're looking at the inflation data right now and probably wishing that the policy rate is a bit higher. So I think this is the context in which we understand the recent comment from the Fed officials. They're trying to fast forward or accelerate and get to a position where they're more neutral in terms of their estimated policy rate as quickly as possible. But from as soon as they get there, we think that they will start to have more room to be more sensitive to incoming data and then assess their next step. And I think that will be a point in time where we should be getting less hawkish surprise from the Fed and potentially making of a slightly more constructive environment for market.